Hi, and welcome back. In today's session, we're going to take a look at corporate valuation. Corporate valuation is a major part of everyday work in finance. Trying to understand whether a company is overvalued or undervalued, whether the company's shares are overvalued or undervalued, is something that we do, and it involves not just the science of using numbers, but it also involves an awful lot of an art. It is a forecasting technique, and as such, it's subject to both miscalculation and misinterpretation. So everyone who works in the business, whether they're actively involved in forecasting, is somehow going to be involved in the use of forecast information. It builds on the forecasting and cash flow forecasting or cash flow estimation work that we did last week. Just as a kind of a reminder that this is a human activity, valuation, we say in a lot of cases, is subject to interpretation. It's subject to hype. You can see from this cartoon from The Economist that it is in a way like a game of Chinese whispers. If you're familiar with that term, here we have somebody who's talking on the phone and he says, I've got a stock here that could really excel. And somebody kind of overhears or half overhears the conversation, says, really excel. Somebody else says excel. Somebody mishears and says sell. And next thing you know, everybody's selling. We have a bit of a selling frenzy going on here. Down to the bottom frame, everybody's yelling sell, sell, sell. And this gentleman says, this is madness. I can't take any more. Goodbye. Which turns into goodbye, bye, bye, and then the frenzy carries on. So there's a logic behind this, but there's also a lot of room for irrationality. And in this part of our session, we're going to try to determine which information about company valuation is rational and which is not. It builds on all of the material that we've covered in the course so far. In fact, at the beginning of each chapter, you can see this particular flow chart that reminds us that the ultimate value down here in the bottom is going to be determined by the sum of the free cash flows from a company from the time that from today right through until infinity. So if we could calculate these numbers, that would give us an idea of the true value or the intrinsic value of the business. The free cash flows come from our estimation, our guesses of sales revenues today and sales revenues into the future, operating costs today and into the future, and also of the required investment and reinvestment in fixed assets. So that defines the free cash flows in the numerator of all of these value terms. In the denominator, we have the measure of risk. So return on the top, risk on the bottom, and of course the risk is defined by the weighted average cost of capital, and that includes the decision whether or not to use debt or equity or preferred shares, the underlying interest rates or the basic cost of debt and the risk-free rate, the amount of firm-specific or idiosyncratic risk, and the risk that we get from the market. All of those things combine to give us the denominator. Now all we have to do is be able to put these numbers together, and in this session we're going to do that. We'll take a look at how to value the cash flows during the horizon period, from today until the point at which it doesn't make sense to continue estimating annual cash flows. And then we have to figure out what the terminal value is going to be, or the value of the cash flows from the horizon right through to perpetuity. And we have to do that for our operating assets. We'll come back to that in a couple minutes. Chapter 22 in our textbook covers a number of topics. We won't cover all of them today, but we'll certainly have a big start. And we'll take a look at some of the key topics. Understanding the value of a business using intrinsic value and relative valuation. Now, intrinsic value uses the discounted cash flow approach, making an adjustment for that terminal value that I mentioned earlier. We can also use the dividend growth or the Gordon's growth model as an alternative. We can also use things like price earnings multiples. And you remember the return multiples that we used at the very beginning of the course. Things like price earnings multiples, price to book, price to sales, enterprise value to EBITDA. Ratios like that can also be used. And we'll take a look at how that's done at the end of this video. Some of the other topics that we won't get into in detail, well, a little bit, I guess. We'll talk a little bit about market-based valuation, EVA, again. We'll talk about some of the special cases where managers run the business not for the purpose of making shareholders better off, but making managers better off. And that, of course, ties in with corporate governance. One of the most fundamental things that we're going to look at in this session is the concept that value is about perception, not about reality. We have a measure of value that's determined by the accountants, and that's basically the balance sheet. How much is the company worth? The accountants, the auditors, over a period of years or decades, have carefully compiled a register of the value of everything that we've bought net of depreciation. That is accurate, but it's not always useful. The value that a company really depends on is the perceived value. The sum of the asset value, of course, but also the value of all of those intangibles, reputation, customer relationships, trademarks and brands that aren't capitalized. Things like that will be an important part of the value of our business. We say that value is about comparison. Which company is more valuable? Is Microsoft a better company than Dell? Is Dell a better company than Facebook? So we use comparison, and that will be certainly part of our approach. In the eyes of the beholder, value is going to always be unequal. For a friend of mine who's got a classic sports car, a 1967 Ford Mustang, he has the most valuable asset on earth. According to him, the car is worth about $50,000. According to somebody else who just sees an old car, they'd say, why would anybody pay $50,000 for a car that doesn't have electric windows, that doesn't have cruise control, that doesn't even have an automatic transmission? Well, the only time that we actually know the value of an asset like that is when it's sold. So comparative valuation is going to be important. And that difference is going to be, the difference in our perceived value will be down to a number of things. One of those things could be synergies. If we buy an asset, it won't just give us the ownership of the asset, but it may improve some of the assets that we already have. For example, when a car company decides that it's going to buy a competitor, not only does it get the factory that builds the cars and the inventory, it also gets the distribution channel. It gets all of the dealerships in all of the different centers. Now, if there is a huge mismatch between those assets, if one company has most of its dealers in urban areas and another one is all suburban, now we've got a distribution channel with pretty much universal coverage, something that companies are always looking for. So perhaps the dealer network. And now, dealer network on the books has no value, but it could be an intensely important part of the valuation. To create growth opportunities. In fact, some of those things we talked about in the real options session. An opportunity to expand into a market much faster than if we grew organically. That could be a part of the value of the business. Something else that's important could be market share. Now, typically, government regulators don't want us to have substantial market share because it's anti-competitive. But if we can push the limits of what the government will allow us to do, then we can perhaps create some value by being able to set prices. For example, when a supermarket chain that is national except on Vancouver Island wants to expand into Vancouver Island, it could do so organically, but here's the problem. All of the best locations have already been taken. And there's a very substantial competitive framework already in play. So their approach is to buy a local company. Not only do they get the local company, they get the locations, they also they've got market share. Not just 4 or 5%, but they've got over 25% market share, which allows them to sell their goods perhaps for 1 or 2 cents more per unit. And that extra little bit of cash turns into a value of billions of dollars on top of the value of the company. And adding their own national sourcing, their national value chain, they can make the local company more efficient. So that is an example of a couple of different synergies of market share, for example. Another good reason would be to stop somebody else from having it. Kind of like when you were kids and you're playing around with a brother or sister, you wanted the toy, but more than anything, you didn't want them to have it. It was a competitive thing. Well, market denial might be part of that. For example, we see in many instances when there's a competition to acquire a company, two companies are fighting to acquire that other company. The reason might be preemptive or preemptive expansion or denial of a market. When Skoda was for sale, I don't know if you know Skoda cars, not famous at the time when they were a Czechoslovakian company. They weren't famous for their quality, for their brand appeal. In fact, if you asked anybody in Europe, they had a joke about Skoda cars. Sort of, things like, why does a Skoda have heated rear windows? So you can keep your hands warm when you're pushing it. Not famous for being a dependable car. However, it did give whoever bought the company the opportunity to expand into Central Europe at a time when the market was starting to grow. And also it gave you an opportunity to produce cheaply at the edge of the developed part of Europe at the time and be able to sell those cars into the more developed market. For that reason, we ended up with two bidders that were in a very extreme bidding war, Volkswagen and the company that owns Renault. They were fighting to own the company, and Volkswagen definitely wanted to buy the Skoda business, but more than anything, they didn't want Renault to have a factory right in the edge, in fact almost in the middle of their most important market. So they overbid to buy Skoda, mostly to stop Renault from having it. So that would be market denial. To stop a competitor or an emerging competitor from being able to grow, to take away their oxygen, it might make sense to be able to expand into their market and steal all of their business. So if you can't buy their company, you'll buy their competitor in order to deny them room to grow. This is just a very short example of what we define by synergies. So certainly the value of the company is equal to the value of its assets, but also they're a set of synergies. And sometimes these can be valued using real options. We also have a choice of whether or not we're going to use things like discounted cash flow or whether we're going to use a simpler and perhaps less accurate method of using the return relatives. Intrinsic value is essentially the value that the company should have based on the cash flows that will be available to the investor. So if we invest $1 million in the project, invest $1 million in an acquisition, will that be worth more than $1 million, or the present value be worth more than $1 million? And do we have a positive NPV, or even just a present value of the investment? We can use the dividend flow or the free cash flow. Return relatives are less accurate, but they give us the advantage of being able to use comparisons. For example, if we see the average price earnings multiple in an industry is reliably 20 times, if we know what the earnings per share are predicted to be in the first year of our business, we can multiply the earnings per share times that 20 times, and that'll give us a very quick and easy way to value the business. And we actually see that's used on a regular basis for certain industries, especially where serial acquisitions, one acquisition after another happens. Most importantly in all of these things, we choose the method that is going to be the easiest and the most dependable given the information that we've got. And this is something that is defined by Occam's razor. Now, William of Ockham was a monk in, I think, the 15th or 16th century, who essentially said that given a number of competing solutions, the one that is going to be the simplest is typically the best. So we look for the simplest model that works. Here's an example of how that would work. If we're thinking about valuation, we can take a look at the business using the accounting method, essentially using depreciated value of assets, the company's balance sheet, a collection of half-worn out assets. We can value the business using the present value of future cash flows based on either dividends and use the dividend growth model, or the earnings and use a cash flow forecasting model. We can value the business as scrap using the gone concern method, or as carcass value. And often we do this when we're looking at a business that is bankrupt or about to go bankrupt. So how much is the business worth if you take away all of the cash flows that would accrue to its its existence, and just take the asset value at salvage prices. Market valuation is definitely the most interesting method, but it only works if we've got market comparisons. And so that means we have to have a relatively liquid market. If I want to value a car, for example, I can use all of these methods. I can value it using the depreciated purchase price. For some vehicles, you'd find that you can get many vehicles at their depreciated value. However, some vehicles tend to appreciate and some depreciate even faster. You can get that information just by looking at the purchase price and then using things like the CCA tables or a fixed depreciation method to be able to figure out what the value of that car should be today. We can value it using its value in use. Perhaps if we plan to use it as a taxi cab and we're going to earn $1,000 a month from the ownership of that vehicle, we can take the present value for the next 5 years or 3 years, let's say, of that taxi cab and just use that to value it as a business. We can value it for parts. So if we took it to the wrecker, how much could we get? $500 for parts or $400 as a going concern. The car's worth more for scrap than it is as a going concern, so we'd scrap it. Market value is actually quite easy to determine because we have a regular purchase and sale of that kind of an asset. And there's a summary that's produced. You can find it on the internet, usually a name like Kelly's Blue Book or the Black Book, the Canadian Black Book, I think it's called. Essentially, that gives you the value of comparable sales in the market for the last 3 months. And so if you have a liquid market for your vehicle, then that's no problem. So if you're selling something like a Toyota Corolla, no worries, there'll be a lot of those vehicles sold. If you're selling something like a 1967 Ford Mustang, not so many sales, and so you probably wouldn't find a representative price using comparables. Essentially, it requires information, requires deal flow in order to be able to determine that. An interesting example we have that really starts in the 1980s is a question of how much a car company would be worth. And here we're looking at Jaguar. Jaguar was owned by the government in the UK up to about 1984, and they floated the company. And that gave us a way of valuing it, or at least partially valuing it. But we didn't have the full valuation because at the time more than 50% of the shares of Jaguar were owned by the British government. They had something called a golden share that could convert to 50% plus one vote, or one share, so they could stop a foreign competitor from taking over Jaguar if they wanted, or any competitor. So in other words, the British government was trying to protect Jaguar after the IPO by making it only partly a public company. And it was not thriving. By the way, the car that we're seeing here is a much more recent version of Jaguar, a much prettier car than the ones that they were producing, and some of them that they were producing in the 1980s, but much more technologically sophisticated, because Jaguar's biggest problem in the 1980s, even into the 1990s, was that its technology was old. They were producing a sports car with bad brakes, with an engine that was out of date, with a type of carburation that required a lot of maintenance, and they had very poor dependability. They had beautiful leather seats, they had a really nice interior, even the styling of the cars were very nice, but they just weren't a good car. So they had to fix it up, and the British government knew that. They hired consultants to help them with this, and the consultants all came back and said there's nothing that you can do unless you as a government invests millions of dollars in reconstructing the company. At the time we start looking at the business in 1984, after the IPO, the company has got a value according to the accountants, a depreciated value of the business of 280 million and so many pence. Right down to the penny, they know what it's worth because the auditors over the previous 30 or 40 years have been paid really hundreds of thousands of pounds in order to do an audit every year to account for every nut and bolt. And they say this is the exact value of the business. But we know the business is worth more than that. We know that because it's already a public company. And after they did the IPO, the value of the business, including the 50% that was owned by the government, came to about 630 million pounds. Of course, varying day to day along with the share price. Now, the business could be worth much more than this, possibly or potentially, if it was going to be taken over. And at that point, the British government hired a couple of consulting firms to look at valuation. One of the firms my students looked at in the early 1990s, when they did it, this is a company project, they looked at the valuation by comparing Jaguar to a number of other sports car firms that had been taken over by other foreign competitors, things like Ford taking over Lotus, and Lamborghini had been taken over. Porsche had been partly taken over. So we see that there had been other acquisitions, so they could find comparables. Now, working with a number of different sources, the main consultancy firm that produced a report was Coopers and Lybrand, an accounting firm that also had a valuation practice. And they estimated that if this company could be sold to a single buyer, it could be worth over £1 billion, about £1.1 billion. Essentially, that would mean that the British government would have to give up their golden share, and that would make the company worth almost twice as much. So here they've got nearly 4 times the book value and twice the current market value. The British government looked at this and said, we're not going to put in new money for technological improvements, for development of a new engine. So we're going to have to consider selling it. They essentially did that. They told the stock market, essentially, they told a couple of investment banks that they would like to have help finding a buyer. And so the word went out. A number of companies expressed interest. 2 in particular were very interested, Ford and General Motors. Now, both of those companies needed to improve their sports car line, especially the one that was targeted at those middle-aged and wealthy car buyers who were looking for a sports car. And not a little rocket ship that they could run around a racetrack, but one that they could drive to the golf course and use to impress their friends. So Jaguar seemed to be a good alternative for both of those companies. Now, General Motors in particular was aware of the value of a sports car brand. They'd spent over $1 billion US dollars to develop a new car called the Alante, Cadillac Alante, and it was a complete flop. They only sold a couple of 100,000 units. It was very expensive to produce, and so they said for perhaps £1 billion we could buy a whole company, including all of the manufacturing and the market, the distribution channels, everything is there, and we can reinvest in it and improve it. Ford and General Motors looked at this, and Ford wanted the company as well. They didn't have anything that would compare. But more than anything, they didn't want General Motors to have it. And so after a number of competing bids, the successful bidder was Ford. They bought the company for about $1.6 billion, about 1993 or 1994. They had now had the business that they could build on, but most importantly, General Motors didn't have it. So it was the value of denial was part of it. And when you think about all these values, here we have the value of the fixed assets. We have the value of the company as a tradable entity. We have the value with a premium for majority interest or majority control. That's what the broker's estimate was. And then we have the value that includes the strategic value of an extra $500 million that Ford paid to stop their competitor from having it. In the end, Ford was not fully successful with this. They invested about another $3 billion US in Ford over the next few years, in Jaguar over the next few years, and they found that the business wasn't terribly successful. They stole some of the best design ideas from Jaguar and incorporated it in Ford cars, so in that respect it was quite useful. But after a number of years of owning it, they sold the business eventually to an Indian company called Tata. And here in 2020, Tata is considering doing another IPO and taking Jaguar public again. So we have a whole new round of valuation yet to come. Essentially, when we talk about corporate valuation, we're talking about the process where managers use financial forecasts under alternative circumstances or strategies to determine what the cash flows of the business are going to be, and then choose the one that gives us the best positive present value. Companies are made up of two types of assets. They have the assets that are essentially part of their operations, and then they've got cash. Cash itself is very easy to value. $1 billion is worth $1 billion. $1 billion worth of plant could be worth 1.1 or 1.2 or 0.9, depending on its value and use. So the hard part of a valuation exercise is always going to be the assets in place. Essentially, assets in place are things that are tangible, things like buildings, machinery, inventory. They're the things that are going to produce the growth in the business into the future. They generate the free cash flows, and the present value of those expected free cash flows, discounted at the weighted average cost of capital, is the value of operations. Now, we've done this before. It's a very simple exercise. Essentially, and you recognize the formula, the value of our operations is the sum of our free cash flows discounted at 1 plus the weighted average cost of capital for every year from today right off until infinity or perpetuity. Now, hard to do this, but we'll show you a shortcut for calculating the part from the next few years into perpetuity. So we'll do that in 2 stages. But essentially, that's the value of operations. Non-operating assets are things like the cash that's held in the business, the marketable securities, the money that's kept for contingency, perhaps to do acquisitions, perhaps it's just the cash balance or the cash float that we use from year to year. Usually it's a small part of the total value of the business. It can also be the ownership of part ownership of another company in which the company cannot control management decisions. By that we mean a non-controlling interest. So we value that at its book value, and we call that a non-operating asset. And the value of non-operating assets usually can't be controlled by the firms. It's something that we can't set. The value of cash is the value of the cash. The value of a non or minority interest, the value of that would be something that is outside of our control, and so we just report it at book value. Total corporate value then is the sum of the value of our operations, the present value of those future cash flows, plus the value of our non-operating assets. Firms can only influence the first and not the second, and so that's why we focus on the value of operations. Set against the value of the company, we have claims that don't accrue to our shareholders. They're not our money. For example, the debt in the business is money that is owed to the bondholders, and so we're always going to deduct that from the value of the enterprise to figure our equity value. And even the preferred shares are going to be a claim against the company, so we have to take that out of our total value in order to determine the equity value. Anything left after taking out debt and preferred is the value that belongs to the shareholders. We can calculate this value by using standard corporate valuation. As we start off with a forecast of our financial statements. From that, we're going to calculate the projected free cash flows and take into account risk in the next stage. It's a model that can be applied to a company that doesn't pay dividends, a company that does pay dividends, privately owned or publicly owned company, a division, a business unit within. It can be used to value almost anything. Free cash flow can be applied in any of these situations. Now, I have a couple of examples, a simple example and then a more complicated example that we'll look at next. For the first example, we're going to assume that our free cash flow in our first year is going to equal $20 million. We have a weighted average cost of capital of 10%. We're expecting to have growth of 5% right through to infinity. We have $100 million worth of cash assets in the business, $200 million worth of debt, $50 million worth of preferred, and the book value of our company's equity is $210 million. So the company that we're looking for, we need to be able to value the cash flows. And of course, you remember we can now calculate the value of operations a couple different ways, but we'll start off by looking at the value of our free cash flows discounted by 1 plus the weighted average cost of capital. Now, our cash flows in the next period, and that's why we have in the bottom part essentially says the free cash flow at time 0 has to be multiplied by 1 plus the growth rate to get the free cash flows in period 1. So that's where we're going to start off with. And we're going to value them 1 year at a time right through until infinity. We can calculate that using a constant growth formula. And essentially here, you see that we're taking the value of the free cash flows, or the sum of the free cash flows at time 0, and multiplying them by 1 plus growth over 1 plus the weighted average cost of capital. And as we get to a very long point into the future, a very distant point into the future, as the t gets very large, this term is going to start to approach 0. So ultimately, we say that that can be reduced to, or at the limit will be, the sum of the free cash flows discounted by R minus G. Essentially, this is our value of a perpetuity, a simple perpetuity. I'll show you an example of that in a second, but the simplest possible example, imagine that somebody's going to give you $100. And we're going to discount that as a simple perpetuity at 10%. So we'd say discount that at 10%. That means that the value of $100 received every year from now until infinity, 100 divided by 0.1 is going to equal 1,000. Now that's a simple perpetuity. This is called a growing perpetuity because it deals with R minus G. So if we had $100 as our free cash flow, 10% is our discount rate, and 5% is our growth rate, that would be 100 divided by 5%, or that would equal $2,000. So essentially says that the value of our growing perpetuity would be worth $2,000 today. It's a very simple calculation, but it's an important one because it helps us to be able to value the cash flows a long way into the future to perpetuity. Using the numbers that we have from our case, here we're using that same formula, the free cash flow that we're going to have in period 1. We said 20 million was our cash flow at the beginning, growing at 5%. So 20 million times 1.05, or $21 million, divided by R minus G. 21 divided by 5% gives us 420 million. Really simple model. Essentially it says the value of our company is 420 million. Another way of saying the value of our company, our enterprise value. Now, we are interested in the value to our shareholders, not just the enterprise value. So we have to, in the third step, make an adjustment. And that adjustment is for the value of equity. We just said the value of our operations was 420 million. We also said the value of our cash, our marketable securities, was 100 million. So the total value of our business, 420 plus 100, $520 million. Set against that, we have the claims. We had the debt, the preferred shares. So if we take the 520 minus 200 minus 50, 520 we see in the top part is the total enterprise value or corporate value, minus the debt, minus the preferred, essentially says the value of our equity is 270 million. That's how much you'd pay to buy all of the shares in the company, according to the predictions based on our forecasts. A very simple calculation for a company which produces the same amount of return year after year. No complications. If you wanted to know what the contribution to the EVA is, we'd look at the market value, and the market value added for this business is essentially the total corporate value of the firm minus the book value. So how much has the company produced over all of the years by summing up all of the economic value added and subtracting from that the book value of the assets? It's the total book value. The total book value of the firm is equal to the book value of the equity, the book value of debt, the book value of the preferred shares. So the total value of our company is going to be 520 minus the sum of all of those claims. the book value, the debt, and the equity. And so in other words, market value added $60 million. That means the company's created $60 million of cumulative EVA over its entire existence. You can see a breakdown graphically of the corporate value in this next slide. Essentially, it says in the first column, the corporate value is made up of $420 million worth of the operating assets, $100 million of the cash assets. Claims against that include the debt, the preferred, and what remains is the total equity at the market price, the $270 million. Against that, we have the claim of the book value, and so this little blue box in the third column represents the market value added. It's a positive number, so of course that's a good thing. That's a simple example. It assumes that the company is going to expand at the same rate every year. Every year the growth is going to be 5%, so 20 million the first year, 21 million the second year, 22 point something the next year, and so on. We have a constant growth at a rate of 5%. That would be a simple way to do the calculation, but unfortunately most businesses aren't that simple. So we have to deal with a problem of non-constant growth. And in this particular example, we'd say, well, what happens if our company grows? A company grows typically by borrowing and also by cutting our dividends, and the rate at which we're going to grow is going to vary from year to year. In some years, we're actually going to have a downturn. So we predict next year we're going to have free cash flows. They're going to go from 20 million down to 18 million. And then the next year, they're going to go down by 23 million, negative 23 million. The year after that, positive 46. The year after that, they're going to be 49 million. And so here our cash flows, negative, negative, positive, positive. They're different every year. After year 4, from year 5 until infinity, the free cash flows will then grow at a rate of 5% per year. These are our assumptions. These are our guesses or our forecasts. We have got other information in this different example. It says our weighted average cost of capital is 10.84%. Company has 100 million shares outstanding. The value of its non-operating assets, its cash assets, are 63 million. Debt is 247. Preferred stock is 62 million. So we're going to deal with this again in 2 steps. We're going to take the value of the cash flows during the period that we have information. Year 1, 2, 3, and 4, we have information about the sales, the expenses, the cash flows. We've got that information for the next 4 years. From year 5 until infinity, that's stage 2. So stage 1 we call the horizon. Up to the horizon, we're going to value these cash flows. So we're going to forecast the present value of those cash flows for the first years of the example, for our 4-year horizon period. And we're doing that because the growth during this period isn't constant. We need to calculate the value of present value individually year by year up to that point. Then we say in the second stage, the growth is going to be constant after we reach our horizon from, say, 2013 onwards in this case. And so for that one, we can use the constant growth formula we saw in the previous example, discounted back to its value in year 4 at the horizon. The value at the horizon will be the sum of all of the free cash flows from year 5 to infinity, growing 1 year at a time at whatever our growth rate, I think we said 5%, discounted by R minus G. So the value of the cash flows from year 5 to infinity are going to be $49, which was the last cash flow we received in year 4 according to our original assumptions, times 1.05. That'll give us the cash flows for year 5, discounted by R minus G. So it says the present value of the cash flow in year 4 for the perpetuity is $881 million. Makes a lot more sense when you look at the next chart. Here we can see all of the cash flows from now until infinity. Next year we're going to have minus 18, the year after that minus 23. Then we're going to have plus 46, plus 49. The next year it's going to be 49 times 1.05, and that's going to give us 51.45. That's the total cash flow in 2014 onwards to infinity. We discount each of these back using 10.84 as the discount rate, so 18 million negative becomes minus 16.24, minus 23 becomes minus 18.72, 46 becomes 34 million, and 49, well, 49 is something, 49 is going to be calculated a little bit differently, because we're going to add to that the horizon value. Remember, our horizon value was 51.45, or 49 times 1.05, discounted by R minus G to give us the value of that perpetuity, that growing perpetuity. And that gave us the $881 million for the growing perpetuity. We add that to the 49, and it says in year 4 we're going to have a total cash flow for the year plus for the perpetuity of $930 million. Discounted at 10.84, that means in present value terms that's $616 million. The sum of all the present values gives us $615 million, and that becomes the value of the operations. So in 2 stages, the cash flows from today until 2013. Then we take the perpetuity, and then we discount that at 10.84%, and all of that together gives us the value of the company. Now, this company, which in our textbook example is called Magnavision, has a value of operations of $615 million that we just calculated. We also said they had cash assets of $63 million, so the total of this then is going to be $678 million. Now, against that, we have the claim of debt, and we have the claim of preferred shares. So the total value of the business, the total enterprise value, minus the stock, preferred shares minus the debt, means the value of the common equity will be $369 million. We also said, just out of interest, that the book value of the equity was $245. So 369 minus 245 means the market value added was 124. So that's the value added to the business over time. That's how we'd value a company like this. Now, the next step that may be of interest to you as a shareholder is, how much is my share worth? So you'll see on the next example, again, just from the textbook, that we have the value of the operations, the value of the non-operating assets gives us enterprise value. We subtract from that the debt and the preferred shares to get the value of common equity. We also said there were 100 million shares outstanding. So $369 million divided by $100 million means the value per share is $369. Now, if the current market price is $3.80, and you've just determined the intrinsic value is only $369, we'd say that the stock is overpriced. It's too expensive. If we saw that the current price of the stock was $3, and we think it's worth $369, you can buy for $3 something that's worth $369. Well, that'd be a good stock to buy. So this is exactly the kind of exercise that we do when we're working on the value of the free cash flow to the firm. That's something we talk about in a little bit more detail in our equity valuation course. There's another example, as well as Magnavision, which is in the textbook, that I wanted to throw in as well today. And this is actually a case study that was a live case study done by some of my students. A company that I kind of discovered when I was on a trip in England, and I dropped into a pub and I was talking to the guy that owned the pub. Turned out he also owned the brewery across the street. And his brewery, which is now a very successful one, was set up as kind of a hobby. His family had set up one of the biggest breweries in Britain and then sold it. They all became multi-millionaires, kind of retired to their yachts. In his case, he built another brewery, a little tiny one, across the street from his pub, and he brewed his own beer. The brewery's called Black Sheep Brewery. And when I visited him, I thought, well, not only is it kind of interesting craft beer at a time when craft beer wasn't so popular, but he had some great brands. Black Sheep itself has got a lot of interesting meaning. Some of his brands, like Rigwelter, was a Yorkshire term for a sheep lying dead in the field. Essentially, that was a very strong beer. So he had all of these great names that would not only be catchy, but they would certainly appeal to one of his most important market demographics, university students. And it turned out when I discussed it with some of my students, they wanted to go and find out more about this business themselves. And so they went out and visited him, gathered information, and did a valuation. And I liked their valuation example so much that I included it in a book that I did in the 1990s. The valuation that we could use to determine what Paul Theakston's business was worth, we could take a look at the net asset value of the company. Essentially, what do the bookkeepers say it's worth? Of course, they don't capitalize things like brands or other intangibles. So clearly that should be an important part of our valuation, that net asset value or net book value of the assets would miss. We could take a look at the value according to the market. What is the market value of the business? And kind of a bit of a pun with a brewery, requires a liquid market. Well, it wasn't a publicly traded company. Paul Theakston owned the business by himself, so that's something we would have to work with. We could also value it using price-earnings multiples. Things like the price-to-earnings ratio or the market-to-book value ratio. And we can use the intrinsic valuation methods that we've looked at earlier, using either cash flow multiples, but most likely things like the present value approach, using terminal values, using perhaps a perpetuity, or in the example that we just saw, using a growing perpetuity. Now, the forecasts that the students got from Paul, basically written down on a napkin while they're talking to him in his pub, said that in 1995, the year when they did the actual bit of research, the company had sales of about £2.3 million, operating profits of 103. So their basic cash flow, when you added back depreciation, was £190,000. They had working capital, so they discussed the working capital, discovered the year change in working capital was $74,000. That subtracted from the basic cash flow gave us the operating cash flow. No tax paid, a certain amount of capital investment. That meant the free cash flow after taking out the capital investment required was $97,000. Well, they did a forecast based on this information and growth forecasts that they got from Paul, and they could see what the growth was expected to be over the next few years in the sales. And they did the percentage of sales method that we described earlier to determine what the cash flows were going to be. And so these were the numbers they came up with for the period from 1996 right through until 2000. So for the forecast period, or for the horizon period, these were the present value of the cash flows. When they discounted them at 15%, this was the present value of our cash flow. So from today until 2000, 96 until 2000, the present value of the cash flows during the horizon period was $714,000. Now, they used the method that we saw earlier to calculate the terminal value, the period from 2000 to infinity, using that perpetual growth model. And so we've got our cash flows times 1 plus G, discounted by R minus G. And then, just to make it simpler, they discounted the value back from year 5, to the present at 1 plus R to the power of 5. Well, essentially that meant that they were valuing the asset using the information they had at the present, and then with the current growth rate, they would be predicting from now until infinity at that rate using the second part of the equation, the terminal value forecast. So when they put all of those numbers in, their formula said that cash flow of 295,000 times 1 plus their growth rate of 8% gave them a terminal cash flow of 319, discounted by R minus G, gave them a terminal value of 2,266,000. Add that to the 700,000 that they got from the horizon period, gave us an overall present value of the business with a growing perpetuity of £2.98 million. Now, we actually knew the business was going to be worth more than that, but at the time, that was our best estimate. So in this case, one of the problems that we see is with our growing perpetuity, the terminal value is a big part of the total value of the company. We only got $700,000 in value from year 0 to year 5, or year 1 to year 5. And so most of the value came from the terminal value. And that's a bit of a problem, because a small adjustment in our cash flows in the year before our terminal value means a big difference in the total value of the company. And I'll show you what we mean when we go back here. And here we said that our guess for sales in year 5 is 5.56 million. And our operating profit, basic cash flows, change in net working assets, and so on, these are all our guess for 5 years into the future. What if we're a little wrong? What if our working capital is going to be twice as big in that year because of some kind of a change in the business? That would mean perhaps the present value of our cash flows would fall by almost 100,000, and that means that this would fall by 100,000, and that means that the value of our terminal value would fall by $500,000. Yeah, that would actually be quite a substantial difference in the value of the business. So the number that we are least convinced about is the one that receives the greatest amount of weight in this approach. That's one of the basic and fundamental problems with doing this type of cash flow forecasting and valuation. We can use other methods to value the business as well. Remember, I talked about relative return approaches, or market return approaches. In this case, we could compare the company to its peers, and we didn't have many peers that were publicly traded, but we found a few. Now, one of these is a ringer. Scottish and Newcastle shouldn't have been in there, so the students showed up and they said, well, these were some of the companies that we found that were publicly traded. And I said, you got to be joking. And they said, yeah, actually we were. Scottish and Newcastle, forget about them. Not only are they a huge multiple of the size of our company and the rest of the peer group, but they also own pubs, and they have hard alcohol distilling businesses that are part of their business. So they're a very diversified company. They're not at all like Black Sheep. Some of these other ones are a bit closer, but they're still a lot larger. They're publicly traded. Green King, Marston Thompson, Fuller Smith, Jennings. These are companies that are of a similar size. They're a true peer group. The net asset value of these companies is still a lot bigger than our company. £250 million versus about £1 million. So they're definitely much larger companies. They're traded on the stock market, and so we know what the market value of the business. And in fact, interestingly, the market value of these businesses are relatively small compared to many other publicly traded companies. They're only about 1 time their market value. The average is about 0.98, about 1 time that value. Now, Black Sheep doesn't have a market value because it's not publicly traded, but we could say these companies on average have a market value of 98% of their net asset value. So 98% of 1.033 million would be 1.015 million. Essentially, very simple, very easy to use. Often used for valuing private companies because it doesn't require any information other than the company's net asset value. We can also take a look at the market to book value ratio. You remember that ratio from the beginning of the course. We talked about Tobin's Q as well. Here we can see the forget about the Scottish and Newcastle, but for the peer companies, excluding this company, you can see the average price earnings multiple. Here we've got price earnings multiple. Average price earnings multiple for these companies was 18.83 times. This company has an earnings per share, or in this case a profit after tax, of $103,000. So 103 times 18.83 would give us a total value of the company of $1.9 million. We could also do the market to book value ratio, but we haven't got that here. So we could see that the different valuations that we got start off with the value of the business. The highest value is the value of the business using the free cash flow and a growing perpetuity. That was $2.98 million. The next value was the present value using a simple perpetuity with zero growth. That gave us about 1.7 million. The value using a price earnings multiple gave us 1.9. Using a market to book value ratio that I didn't show you in this session, that was about 1.015 million, and the book value was 1.033. Now, if I was going to sell the company, and I know Paul Theakston was not planning on that, he would say the minimum that he'd accept would be the highest valuation. And if you were offering to buy, you would be offering something, well, one of the lower valuations. Now, another method that wasn't included in this particular approach is called the EV to EBITDA model, enterprise value to EBITDA. And here's an example of how it could be used to value a company. It was commonly used to value companies that didn't have positive free cash flows, and companies that are in an early stage of development that need to be able to grow could often be valued using a method like this. For example, before we had mobile phones, we had pagers. And I don't know if you have any experience with pagers, but it was a fast-growing business, including in Western Canada. Problem, of course, was you had to put a lot of money up front in order to build the infrastructure, and that meant that businesses would have negative free cash flows for years. They were already going public, and they had negative free cash flows, so we couldn't use any of our cash flow forecasting techniques to value them. We needed to value them because they were starting to consolidate, because there were too many small pager companies, and the market really needed to be rationalized. And so we had a merger, followed by a merger, followed by a merger, that kind of went on like dominoes through the whole industry. We needed to know what values were. And after a few years of mergers, we were down to a few companies, and these were their ticker symbols. You notice many of them are four-digit or four-letter symbols, typically makes them NASDAQ companies. Not many of these are recognized today, but they've now been taken over by other companies like Verizon, T-Mobile, and so on. And so you can see the enterprise value, or the market value of the equity and the market value of debt, divided by EBITDA, earnings before interest, taxes, depreciation, amortization. So we could see what the multiples, say for 1995, were 38, 18, 10, 28, and so on. So the average for the industry was 19.2 times. If you wanted to figure out how much you should pay for a pager company, and you saw that a reliable average was 19 times EV to EBITDA, you knew what the EBITDA was. So you had $1 million EBITDA. 19.2 times the EBITDA would give you the expected value of a company. How much should I pay for $1 million EBITDA company? 19.2 times. About 12 times if you look at the next year's information. A very simple type of valuation measure requires very little information, and all of that information is publicly available. So that is an alternative, along with using price earnings and multiplying that by earnings per share or the company's net income. We could use that as a valuation method. We call those justified earnings multiple valuation tools. Now, the value of the company is not always the value that we've calculated. Some of the reasons for that might be that the company's management is running the company in their own interest and not in the interest of the shareholders. Of course, one of the things that we see as a major corporate governance problem is finding ways to encourage the managers to do their best. They could perhaps be just lazy. They could consume too much of the company's assets as benefits. For example, golf club memberships, company jets, company conventions held in nice resorts around the world. And after all of those expenses, there's nothing left for the shareholder. They could also be making decisions that are not going to produce benefit for the shareholder because they're too risky. Not too risky in the sense that they don't provide a fair return on capital, but too risky in the sense that if it goes wrong, it could damage the manager's career. So we need to find a way to encourage managers to take tough risks, to make tough decisions. They could be rejecting positive NPV projects to avoid looking bad, and perhaps taking on really risky negative NPV projects just to try to create that big splash, doing the project or the job that other managers wouldn't do, and trying to create value for their brand rather than value for the shareholders. Also, keeping too much cash in the company. Avoiding returning capitals by making excessive investments in marketable securities, keeping too much cash on hand, or overpaying for acquisitions. And also by mismanaging information in the business. That's just an example of a couple of corporate governance issues that I threw in there as a reminder that the value of the company is not always going to be exactly equal to the value that we see in the forecasts. This has been a very brief introduction to corporate valuation. I hope you find it useful. Remember that there is more detail provided in the chapter in chapter 22. We go into more detail, more examples, and also it's something we'll be discussing in class over the next 2 weeks. Thank you very much.